Hello, this is Economic Systems and Institutions, Section C, Economic Institutions lecture. Our prioritized standard is Economic Standard 23, and objectively, we're going to compare and contrast the three main types of private business organizations. An economic institution is an enduring organization, practice, or relationship established by people to cope with basic economic problems. So essentially, economic institutions provide support for a type of economy, any type of economy for that matter. There are certain types of economic institutions, with some types existing only in certain types of economic systems. So for instance, labor unions, sometimes called collective bargaining, are only going to be found in democratic industrial countries like the United States. Also, private ownership of property. This is a basic institution that's going to only be found in market economies like the United States. The U.S. also has very specific economic institutions like households, which are individuals or family units which buy goods and services from firms. Also, we have private firms, and we also have banking. We'll talk about banking another time. Now, the household is the typical unit of consumption, which earns income by owning and selling productive resources. So, meaning most of the time when people are purchasing things, it's usually family units that buy those things. And those family units usually make money by selling their services to someone else. It's possible that the government could buy things, other businesses could buy things, but most of the time households do the buying. The profit-seeking private firm is the typical unit of production, as is the typical unit of production in most market economies. Although government agencies do play an important regulatory role in the economy, and some government enterprises actually produce goods or services directly. Stuff like the TVA used to be government-owned, the Federal Mint, Amtrak, the Postal Service, bus lines. Moral of that story, there's a lot of things the government does in fact own. There are three main types of business organizations for private firms in the United States, which are sole proprietorships, partnerships, and also corporations. Now, sole proprietorships are businesses owned and controlled by one person. These make up about 71.5% of private firms, but account for only about 3.9% of private business revenue. These are 2008 numbers, if you care. The numbers don't change much from year to year, though. So this tells us a couple things. There are a lot of sole proprietorships, but they don't make a lot of money. So 71% of all of them, but only 3.9% of all the money. Some of the advantages of a sole proprietorship include ease of startup. You can start these up very easily. Full control. You decide what happens in your business. And also exclusive rights to profit. You don't have to share your money with anyone. Some disadvantages, unlimited liability. So if you get sued, there is no limit to how much they can sue you for if you own a sole proprietorship. Also, you have sole responsibility. You decide what happens, which also means if things happen badly for you, well, that falls back on you too. Also, limited growth potential. You have very limited ability to expand your business with this type. And also lack of longevity. So if an owner dies or becomes disinterested in the business, well, that's the end of the business. Another type of business organization are partnerships, which are businesses owned and controlled by two or more people. These make up about 10% of private firms, but account for only about 14.8% of private business revenue. So if we pay attention to the last one, there's a lot more sole proprietorships, over 70%, compared to 10%, but these actually make a lot more money, 14.8% compared to 3.9%. Advantages of partnerships include ease of startup. It's very easy to start these up. Specialization, meaning there's two owners now, so you can actually divide up the task. Shared decision making, which goes in with specialization. And also shared business revenue, which is more beneficial if you're more of a silent partner, but it's still an advantage. Some disadvantages, unlimited liability. So if something bad happens at your business, you get sued. There is no limit to how much you can actually be forced to pay back if you are sued. Also, potential for conflicts. You might butt heads with your partner and therefore make it hard for your business. Also, there's a lack of longevity. So if one of the partners dies or becomes disinterested, oftentimes that's the end of the partnership. Now, the third type of private business organization are going to be corporations, which are businesses owned by many stockholders or part owners, but operations are controlled by a board of directors, which are in fact chosen by the stockholders. So many people own this, but many of the people that own it have zero say in what actually goes on in the business. So these types, corporations, make up about 18.5% of private firms, but account for about 81.3% of private business revenue. Wow, that's a lot of money. So again, these make about over 80% of the money, 10% of the money, less than 4% of the money. So these by far are the most successful, but the ones you'll see the most of these, over 70%. Then you'll see this second place, this coming up third place in the number of them. But again, this is most successful or least successful. Corporations, some advantages: limited liability. So if your corporation gets sued as an owner, there is very little they can do to you. Worst case scenario, if your business goes out of business, you lost whatever money you paid for the stock. You don't actually lose anything else. Also, separation of ownership from management. So let's say you want to own a business, but you know nothing about business. Great type of business for you. Also, easy to raise monetary capital. They can raise money by selling stocks and bonds, which we'll talk about in a moment. Also, stockholder flexibility. So if you want to sell some of your ownership in a corporation, you can do that. You cannot do that in the other types, though. Longevity. So long after a founder of a corporation dies, business carries on indefinitely. There are some disadvantages, however. It's difficult and expensive to start if you want to go through this process. Thousands and thousands of dollars worth of legal fees commonly. It's going to take a lot of time to do that. Also, government regulates them closely. Government cares a lot more about what happens in a corporation than they do the other types. Also, there's a slow process of decision making, so it takes a long time for corporations to make decisions. There's also a lack of control for stockholders. If you've got lots of great ideas, corporation might not be the place for you, because if you're not on the board of directors, they really don't care very much. And also, corporate profits are taxed twice. So corporations have to pay corporate income taxes before they give you your share of it. When you get your share, then you have to pay individual income taxes. So essentially, those are taxed twice. Now, unlike sole proprietorships or partnerships, corporations can actually raise money to help their businesses grow through the selling of stocks and bonds. So a stock is actually part ownership of a corporation. So they might decide to raise money by saying, hey, we're going to let more people become owners of our business. Just pay us X amount of money. You can be an owner too. Another way they can raise money are corporate bonds, which are interest-paying loans by an investor to a corporation. So a lot of times a corporation, instead of going to a bank for a loan, they'll just say, hey, we'll sell you a bond. Give us money now. We'll pay you back later plus interest. That's usually a good deal for most people that are buying the bonds, because they're going to probably make more money off this type of loan than they would by investing in a bank. It's also good for corporations because they usually pay less interest than they probably would if they got a loan from a bank too. So win-win situation there. Now, corporations can also have the ability to reinvest their retained earnings rather than giving this to stockholders in the form of dividends to help their businesses expand. So if you have a good year as a corporation, you actually have the option to just keep some of that and reinvest it back in your business. Now, other forms of business organizations in the U.S. include corporate combinations or mergers, franchises, cooperatives, sometimes called co-op, and nonprofit organizations. A corporate combination or merger is when one corporation joins with or absorbs another corporation. So one of those types is a horizontal combination, which is a merger between companies producing the same good or service. So like if Kmart, a merchandise retailer where no one goes, merges together with Sears, another merchandise retailer where no one goes, now we have a slightly larger merchandise retailer where no one will go. You can also have vertical combination. So this is a merger of companies involved in different production phases of the same good or service. So for instance, we have Walmart, which is a merchandise retailer. At that merchandise retailer, they sell products. So one thing that's beneficial for Walmart is if they have cheap generic options that they can sell. So therefore, they merged with Equate, which produces Walmart's generic products. So that helps Walmart do their business. Another type of combination is a conglomerate combination. And this is a merger of companies producing unrelated products, which can result in subsidiaries. So for instance, we have Walt Disney Company, House of Mouse, and they merged together with ABC, which that doesn't seem like they have a lot to do with each other, given. So sometimes you can actually have subsidiaries, which means multiple businesses that are a part of the same larger business, but they still do their daily operations like they were their own business, even though they're a part of a larger business now. So there are a lot of talking about consumer products. There are a few companies that own many other businesses. So for instance, Pepsi-Cola, they own Quaker, and Quaker does their own thing, even though they're a part of Pepsi. Also, PepsiCo owns Frito-Lay's brand. So even though they belong to Pepsi, they still kind of do their own daily operations. Also, Pepsi, as you would imagine, makes Pepsi products and many other types of drink products. So they're all a part of the same one big company, but they actually do their own daily operations. So that's what's meant by a subsidiary. A franchise is a type of business where a franchisee, which is a person or a group at the local level, pays a franchisor, which is the large parent company, the right to start a business using the franchise name and selling its product. So these are a lot of examples of franchises. So there are going to be benefits to doing this. I'll talk about that in a moment. Franchisees, should point out, must pay franchise and startup fees and royalties to the franchisor. Now, royalty is a percentage of the profits. So you have to pay. So on the local level, you have to keep paying McDonald's in the beginning to call yourself a McDonald's, and then you keep having to pay them a portion of your profits. Now, why would you do this? Well, franchises can actually make it easier to start a business with a proven reputation. Although there is actually going to be a lack of freedom for a lot of franchisees. So there's pros and cons, although generally speaking, franchises make a lot more money than starting your own business. A nonprofit organization is a business that provides goods or services, yet pursues some goal other than profit. So some examples include things like the American Red Cross, American Heart Association, Goodwill, United Way, Boy Scouts, Girl Scouts, Make-A-Wish, just name a few. So for the nonprofit, revenues can come from the sale of products or services or possibly from charitable contributions. They do not actually pay taxes, but any profits that they make must be put back into the business. So you're not allowed to make a big fat profit with a nonprofit. And the final thing we'll talk about is a cooperative or a co-op, which is a business owned collectively by all members of the cooperative. So if you want to go to cooperative, generally speaking, that means you have to be a member of that. They don't let just anyone go. So lots of types of cooperatives, purchasing cooperatives, marketing cooperatives, service cooperatives. You can also have financial cooperatives. If you're a member of a credit union, that's actually a financial cooperative. All right, economic systems and institutions. Section C, economic institutions lecture is concluded. Our prioritized standard was Economic Standard 23, and objectively now you can compare and contrast the three main types of private business organizations.